Target just announced huge cuts to its corporate team. I mean, huge. They are eliminating 1,800 corporate jobs. Just like that. This isn't some quiet shuffling. This is a massive corporate restructuring designed to shock the system. We are talking about 1,000 people who are straight up being laid off. Plus, another 800 roles that were open and ready to hire, those are gone too, deleted from the books. This entire move slices right through the headquarters staff, affecting roughly 8% of Target's global corporate workforce. 8% is a lot of management walking out the door. And make no mistake, this is the biggest round of corporate layoffs Target has pulled off in a whole decade. That tells you everything you need to know about how badly they feel they need a change right now. The cuts are focused almost entirely in the United States. Target's headquarters is up in Minneapolis, Minnesota, and that area is taking the brunt of this pain. This is a move driven from the top by the incoming big boss. Michael Fidelke, the man who is about to take over as chief executive officer in February, is the one making this call. He's sending out internal memos confirming the cuts are happening right now. If you work at the U.S. headquarters, you have already been told to work from home next week. Why? Because next Tuesday, those affected workers are going to get the news. The day of reckoning is next Tuesday. So, why are they doing this? The official story is simple. Target got too fat and slow. Fidelke said it himself, the complexity they created over time has been holding the company back. Too many cooks in the kitchen. He said there are too many layers of management, too much overlapping work, and that complexity has slowed down decisions. When decisions slow down, new ideas die, and execution stops. Target needs to move faster. It needs to be leaner. It needs to be sharper. This is about trying to rewire the entire corporate structure so they can make decisions instantly and drive growth, not just save money on salaries, even though saving money is always a nice side effect. This isn't just theory either. This is an urgent, necessary step. Fidelke has been running something called the Enterprise Acceleration Office, an initiative launched earlier this year to find ways to simplify everything. Now we see the result of that effort, people losing their jobs. But let's talk about the real reason behind these drastic cuts. The real problems start right at the cash register. Sales have been slumping. They are stagnant. In fact, sales have fallen for 3 straight quarters. That is a massive trend when you are the 7th largest retailer in the entire country. The company itself expects that its annual revenue is going to drop this year. That is a scary forecast for a retailer of this size. If we look at their comparable sales data, which tracks sales at stores open for at least a year, the numbers are ugly. They fell almost 4% in the first fiscal quarter, and then they fell over 3% in the second quarter. These aren't just minor dips. These are signs of serious trouble. Why are people pulling back? Because consumers are changing how they shop. They're buying less of the fun stuff Target is known for, like trendy apparel and home goods. When money gets tight, people buy essentials like groceries, not new throw pillows or fashionable jackets. Target relies on those discretionary items for about half of its sales, compared to rival Walmart, which relies on the fun stuff for only about 40% of its sales. Target is much more exposed to those economic ups and downs. That exposure is costing them big time right now. But economic conditions are only half the story. Target also shot itself in the foot with a massive public relations disaster. Remember the backlash over the decision to abandon some of their diversity, equity, and inclusion programs? That move angered a huge portion of their customer base. Target had spent years cultivating this reputation as a major supporter of inclusion policies, and then they reversed course. That infuriated supporters, and Target admitted that decision weighed heavily on sales. So you have a perfect storm: angry customers, inflation hitting budgets, tariffs impacting import costs, and giant rivals like Amazon, Walmart, and Costco breathing down their necks. This is why we are seeing 1,800 job cuts. Target needs to be stronger and faster to handle all of this chaos. Now, let's look at the damage this has already done to the stock. Target stock has fallen an incredible 65% from its peak back in late 2021. Even worse, the stock is down roughly 30% this year, putting it among the very worst performing companies in the entire S&P 500 index. When a company this big sees that kind of drop, Wall Street gets nervous. Their current financial picture shows the stress. In the latest quarter, sales were approximately $25,200,000,000. That was down about 1% from the year before. Operating income for that quarter was only about $1.3 billion, which is a drop of roughly 19% year over year. These figures show that Target is making less money even as they struggle to keep sales flat. If you look at the volatility of the stock, it's considered higher risk than the general market. That just adds to the nervousness surrounding the company. Despite this, the announcement of job cuts actually sent the stock slightly higher immediately afterward. Wall Street loves to see a company taking aggressive steps, even painful ones, to fix what is broken. Investors are clearly hoping that cutting fat from the corporate structure is the key to turning things around. The new chief executive officer, Fidel K., is stepping into a seriously difficult situation, but he already has major priorities laid out to fix this mess. First, he wants to strengthen Target's merchandising authority. That means getting back to leading the trends in style and design, making people want to buy those discretionary items again. Second, he wants to enhance the shopping experience. This is basic stuff, but crucial. Make sure the shelves are always stocked and the stores are clean. Third, he wants to seriously invest in technology. This means upgrading systems in the stores and across the supply chain to boost efficiency and make sure the customer experience is seamless. He believes these changes will help the company be better positioned to serve customers for many years to come. The good news, if you are working at Target right now, is that these massive cuts are aimed squarely at the headquarters. The workers in the stores and the supply chain, those jobs are safe from this specific round of corporate cuts. However, the cuts are not limited to junior staff. Target is specifically targeting leadership positions. Employees in leadership roles were 3 times more likely to be laid off than individual contributors. They are cutting layers of complexity, which means getting rid of managers. For those 1,000 people who are losing their jobs next week, Target is providing some cushioning. Affected employees will continue to receive their paychecks and benefits all the way through January 3. On top of that, they will receive severance packages. This entire saga is a clear sign that even the biggest, most established retailers in America are struggling in the current economic environment, especially when they face heavy competition from giants like Amazon and Walmart. Target is banking everything on the belief that becoming a simpler, faster corporate machine will allow them to reclaim their status as a retail leader. It's a huge, high-stakes gamble being made right now. Keep watching this story because how Target handles this massive change will tell us a lot about the future of American retail. If you want to know how the market reacts to all this chaos, make sure you hit that like button right now. And if you never want to miss another breaking story about corporate restructuring and the crazy economy we live in, subscribe and ring that bell. I'll see you in the next one.